Again, my name is Jeff Bennett. I am the co-founder of StartupSac. We are a small nonprofit here in Sacramento with the mission to basically grow the Sacramento startup community through by educating, informing, and connecting all the various players in the community, the startup founders, the entrepreneurs, and the innovators. We have a couple of main programs, this being one of them, which is a monthly event, StartupSac Office Hours, in which we bring in a subject matter expert to give a talk about something relevant to startups and founders. Today, we are going to be talking with Bryan Murray, who is working for Bender Insurance, and we're going to be talking about startup insurance milestones, how to manage risk and protect your assets. Before we do that, I wanted to give a quick shout out to our annual sponsors, without whose support we wouldn't be able to do the things that we do. So that SMUD, Witten Law, Bender Insurance, thank you, Bender, Nivigen Pharmaceuticals, Stoll Reeves, Weintraub Tobin, Ernst & Young, Clifton Larson Allen, and Moneta Ventures. So we want to thank all of them. And we want to give a special thanks to our sponsor, SMUD, who is a platinum level sponsor. And we've got a very short 30-second ad that we want to play from SMUD.
In 2030,
in just 9 years, I'll be 18. Off to college,
probably getting my own place.
I want to live where the air is fresh,
where they take care of the planet.
I want to live in the best city,
the cleanest city.
I want to live in a clean power city.
By 2030, SMUD will be 100% carbon-free, so you can live in a clean power city. Join the charge at cleanpowercity.org.
So again, thank you, SMUD, for your support and for all you're doing for the community. Without further ado, I want to introduce our presenter today, Bryan Murray from Bender Insurance. I'm going to stop sharing my screen and turn it over to Bryan. Bryan, you should be able to start sharing your screen. So I think you are good to go. Take it away. Well, let me say one last thing first. For anybody who has questions, please enter them in chat during the presentation. If you have a question, throw it in the chat. I'll try to moderate that. And if it's relevant and you want to get to that right now, I'll interrupt and do that. Aside from that, we have built in some time for Q&A at the end of the presentation. So with that, I am going to turn it over to the Bender Insurance guys. Go, guys.
All right, thanks, Jeff. And you can see my screen, right?
Yep.
All right, perfect. So yeah, welcome to this month's StartupSac Office Hours. I'm Bryan Murray. I'm the Technology Risk Advisor at Bender Insurance Solutions. So quick background, I spent about a decade in the technology space, both in the region and in the Bay Area. Most recently, I was with SkySlope, really great Sacramento company. I was there about 3 years. So I work primarily now with tech companies on their insurance, from startups, like some of you, all the way up to enterprise level businesses. But I'm born and raised Carmichael, and just really, really passionate about helping entrepreneurs, helping founders in any way that I can. And then I'm excited to be joined today by some partners of ours, Ryan Apgar, Brendan Barber from Socius Insurance. Thanks for being here, guys. Can you tell us a little bit more about yourselves and Socius?
Certainly. Yeah, I'll lead off here. Ryan Apgar, Senior Vice President here in Northern California region. Socius Insurance Services is a specialty intermediary broker with a dedicated focus to what we loosely refer to as the executive management lines. So anything ranging from topics of today, like directors and officers liability, employment practices, fiduciary liability, onwards and upwards throughout the professional liability marketplace for errors and omissions, cyber risk, et cetera. We partner with Bryan and Bender team anytime there are clients that are looking to solicit and explore some of those types of very unique insurance products, namely because they are non-traditional, non-standard. Every form is different. The marketplace is nuanced and complex, with new entrants coming in and everyone taking different strategies to underwrite to that risk. I myself have been at Socius for nearly a decade now. Been in the insurance game for over a decade, and oversee our Northern California group. So pass that to you, Brendan.
Hi, Brendan Barber, Assistant Vice President at Socius. Been at Socius for over a year now. I came from the underwriting side, so I was an insurance underwriter. At Socius, I'm our financial institutions director because I had a lot of experience underwriting financial institutions in California. And when I say financial institutions, I mainly mean venture capital, private equity, hedge fund. So I kind of have experience from the other side of things where a lot of these startups are going to be getting funding your first institutional rounds from some of these VC firms. So somewhat of a unique history in the insurance world, but that's just another kind of specialty niche product that Ryan and I kind of work on is insurance for venture firms or insurance for their portfolio companies, mainly revolving around directors and officers, cyber, and errors and emissions. So.
Perfect. Thanks, guys. And you can see everyone why I brought Ryan and Brendan on. Obviously, they have a ton of awesome experience, but they're working with people like you and your clients, and they have a lot of experience with the investor side of things too. So that's what we're going to be talking about a lot today. Here's what we're going to be going over for the next hour or so. We want to make this stuff as digestible as possible. I know you have a million other things you're working on, or clients are working on. You're starting and running a business. We talk to plenty of experienced CEOs and CFOs every day, and they don't know that much about insurance, even if they've done this before, mostly because they don't have to, right? Leave it up to people like us. My goal today, though, is to give you some insurance basics, also provide you with some free or just low cost tools, so really effective tools you can put in place today, like how to create a risk profile for your business. We're going to go through some significant milestones in your company where you need to either look or revisit your insurance, and then just some common sense cybersecurity controls, things that you can implement today, even for your everyday life. All these things, though, are going to make you really attractive to not only insurance underwriters, but also investors. Those two things go hand in hand. So really, really important. Then you're just going to have to bear with me. Got a bunch of dad jokes here. I've got 2 young kids, and nobody wants to hear a super dry presentation about insurance anyway. So we're going to try to keep it light. And then again, Jeff said, if you have questions, throw them in the chat. We do have a dedicated Q&A time later, but I'd love to have this be somewhat engaging if you have questions throughout, if you need some explanation on something we're talking about. I do have a quick poll here, so let me get that launched. Basically, just wanted to see what stage your business is in currently. I know a couple, Justin is here, Lee, you're not all founders or startups. Some of you have clients that are, but if you are, feel free just to let us know. Definitely wanted to see who we're talking to, and then, we'll take it from there. All right, let me share the results as I go into the next slide here. So a lot of idea stage people, and this is perfect. Some pre-seed, some early stage folks here, but that's exactly what we expected for StartupSac group. And let me just stop sharing here. Okay, so just like this guy here, noble warrior, all of you are risk takers, right? By definition, promise this video is not graphic. By definition, entrepreneurs, small business owners, you're very risk tolerant, or else you wouldn't be able to do what you do. But that's part of the reason they're so fun to work with as well. And then even, tech company slogans are hint that they like a little danger. Facebook used to say, move fast and break things. And while it sounds kind of cool, it's not exactly what your insurance underwriters want to hear. And you can still take risks in your industry while protecting yourself. And we're going to send these slides out as well, so don't worry. Sorry about the smaller graphics there. But the most important part of having a dynamic risk management program is really creating one and then continually updating it, writing it down. As you grow, as you pivot, things are going to change. But take these 4 things, the risk avoidance, mitigation, risk transfer, risk retention, and start to apply that to your business in particular. Are there risks you can completely avoid or mitigate with just a few simple steps? How much risk can you transfer to an insurance company? You're going to have to be budget conscious about that. How much risk are you able to accept as is? And you don't have unlimited budgets, of course. I'm sure you're on tight budgets, so you can't buy all the insurance, but you're going to need to look at the different exposures your company faces in particular. because they're going to be very different for a retail business versus a tech company versus a health and wellness company. So let's get to the milestones, and I can give you more information about the risk management program, but I think the milestones are going to frame things even a little bit better for everyone. So these are just steps you need to think about in your business, inflection points, whatever you like to call them. They're just good opportunities to not only look at your current insurance program, if you have one, but look at those dynamic risk management programs we just talked about. And then the first thing you do is, the first step, I guess, first milestone is when you're actually forming your business, just like the guys at Pied Piper here. Hopefully you've all seen the show Silicon Valley. It's hilarious, but it's also a pretty good depiction of startup life in the Bay Area. So if you want to be in the 3 Commas Club, everyone, you need to protect what you're building. So the plan here is to give you just an introduction to the basic coverages you're going to need at each milestone, and then what factors the carriers and the underwriters consider when they're quoting these coverages to each business. Very basic level, the carriers or the companies that actually insure your business, you are transferring your risk to them for a cost, which is the premium. You've probably heard of big carriers, ones like Travelers. They have commercials. They sponsor golf tournaments all the time. Travelers, the Hartford, Hanover, CNA, things like companies like that. The underwriters, they're the ones who work for the carriers to analyze your risk and then quote you accordingly. Apologize if this is very basic or stuff you already know, but it doesn't hurt to give you the basics. So when you form your company, you should have a very basic general liability policy, which is going to be the foundation of your insurance program. General liability protects you against third-party claims for bodily injury, property damage. Third party is just anyone that's not you or your employees, but it also includes advertising and personal injury claims. So a typical example, if a customer slips and falls in your restaurant after you mop the floor, they can sue you for that, and sue you for the medical costs, but the GL will actually cover a lot of those costs. It also covers your costs associated with a product loss too. So if a customer sues you because your software product doesn't do what you said it would do, the GL can actually kick in during that. And then even if you've done nothing wrong, and this happens all the time, if you've done nothing wrong at all, the legal fees alone, if there's a lawsuit, can eat into your hard-earned revenue and your hard-earned funding. Business owner's policy is similar. It's called a BOP, and it's actually designed for small and medium-sized businesses. It's basically a bundle of general liability, commercial property, business interruption. So these are the main factors down here, those 6 factors that underwriters are going to use to measure your company's risk profile and then quote your possible coverages. Basically, it's how much you're gonna have to pay for it, how much money you're covered for. And then for those of you starting brand new companies, I saw there were some people in the idea stage. They're gonna wanna know, have you been part of other startups before? And either way, they're gonna look at data for similar industries to determine your coverage. No matter what though, underwriters are going to try to understand your company's potential. And this is just very similar to how an investor would, how a VC would. So this is why it's so important to work with insurance folks that understand your industry and understand your business in particular, because the brokers, like me, are the ones who actually present you in the best light to the underwriters. They're going to take your pitch deck, your business plan, your funding to date, any future funding plans, and your background in particular to create a compelling narrative on why that carrier should write the business, why they should back you. That's what the brokers, a big part of what the brokers do. And of course, underwriters, they're looking at data. That's more and more important. They have more data to work with. But at the end of the day, it's still just a human being making a subjective decision on what businesses they want to write. Okay, gratuitous cute dog photo here. But here's where things in your business are starting to get more interesting. So you're forming your board or you're getting some sort of institutional funding. There's a lot more things you need to think about now besides just some general liability or your BOP, that business owner's policy. Also, finally, I did a break, drink some water. I'm going to turn it over to Brendan and Ryan, who are going to handle this milestone here.
Got it. Hey everyone, Brendan again. So if general liability is the foundation of your first insurance program, right? Think of D&O as the next step, right? This is when your business is probably starting to get exciting, right? You're getting institutional investors or angel investors coming in and they want a piece of the action, right? D&O is the foundation for protecting you and the rest of your directors and officers from suits of negligence or mismanagement, right? So the basis of the D&O policy is that it's going to protect you from lawsuits from both investors, competitors, and regulatory agencies. And it's going to protect both your personal assets and your company assets. So as companies grow, their exposures increase. But this is really the policy that's going to protect you as an individual manager the most. So Brian, I don't know if you want to hit the next slide there. I thought it might be helpful to just go into, it's kind of a lot going on in this photo, but these are the basic components of a D&O policy. And for the purposes of this presentation, we're really just going to focus on side A, side B, and side C. The other ones like excess and side A DIC are really for kind of larger companies or public companies. But the basic core components of a D&O policy are that side A, side B, and side C. A little counterintuitive, but I'm going to start with side B. Side B is really where you transfer the risk to the insurance company, right? So everything that you do as a director and officer is usually going to be indemnified by the company, meaning that the company will protect and pay for your defense in the event of litigation. So what side B does is you can transfer that indemnification to the insurance company, where they'll actually pay for the legal costs and the indemnity that the company owes you, right? Side A is a bit different. It steps in when the company's not able to indemnify you, excuse me. And that could be from reasons such as bankruptcy, or it's not indemnifiable by law, right? So side B is where you really transfer the risk to the insurance company, and you still have to pay what's called a retention. It'd be like your deductible with an auto insurance company or something. But side A is really for when the company or the company cannot indemnify you, and then you wouldn't have to pay a retention. Those are just the main components of personal protection for you guys. Side C is what we call entity coverage. This would be considered like a claim from a competitor, or a claim from a client, or a claim from a regulatory agency. It's really meant to indemnify and protect the company or the company's assets. And so those are the three components that really make up a D&O policy. The first is to protect personal assets of the directors and officers, and then the second is to protect company assets, aka protect the balance sheet. And those three pieces kind of all intertwine to provide that protection for you and your startup. Do you want to hit the next slide? So this is just another graphic that kind of shows what I just explained, right? So side A is mainly for personal asset protection, personal assets of you at the board members. You actually should start with the directors and officers, right? It's protecting the C-suite and the company employees and their personal assets. Side B, mainly considered balance sheet protection, protects the balance sheet because the company would have to indemnify you in the event of a claim, but you can transfer that risk to the insurance company. Side C is a little different. We kind of talked about it before, but it really protects the company from certain claims. The best example would be a securities claim in the public space, right? I know you guys aren't public companies, but that would be the protection that would apply in a securities class action. And then, Brian, you want to hit the next slide? So this is just some high-level stuff of when should you consider purchasing D&O, right? If you're a pre-seed company or an idea stage company right now, you probably don't need to consider D&O right at this time, but you should think about it as something you should think about it close, down the road very closely. Yes, as a poor way to put that. But usually what will happen is when you get your first institutional funding, or say a seed round of funding from an angel investor, those angel investors or VCs are going to require you to carry D&O because they want to protect their investment in you, right? Oftentimes, they're also going to have a member either join the board or become a board observer. They're investing in your company, and so they want to see it protected from potential litigation. And they also want to protect themselves in the event that they're on the board and could get named in a lawsuit. So oftentimes you're going to get that check, right? That institutional check, and it's going to come with a little caveat that says, now you got to spend $10,000 on D&O insurance. But it's okay because we just gave you $10 million bucks in funding, right? So that's really when we see most startups purchase their first D&O policy, is that first stage of institutional funding. The other thing you can purchase from, let's say you kind of start your company, not the new cool tech VC way, right? And you just do it on your own, or you get some friends and family money, or you raise some debt, right? When you raise debt, that's another, key indicator of probably when you should be purchasing D&O. Because in the event that you default on that debt, or, God forbid, go bankrupt, it can serve as protection for your balance sheet and so on. Oftentimes D&O is required when you sign a big contract with a client or a vendor, or when you bring an independent director on the board. The same way as having an institutional, venture funding firm or angel investor, independent directors probably won't serve on your board unless you have adequate limits of D&O coverage. Also, it's just for you, right? It protects your personal assets. So, if I know we talked about in the beginning, entrepreneurs are more risk takers than not. Well, if you're one of the lower percentage non-risk taking entrepreneurs, you might want to have some personal protection for your personal assets, because your personal assets are on the line in event of litigation. So next slide, Brian. And just like with the BOP and the GL, we kind of highlighted some of the factors that go into your D&O insurance premium. Usually the biggest with D&O is how big your company is from an asset or valuation perspective, and then prior litigation history. But we're in what's called a hard insurance market right now. And that just means that rates are going up, limits are being cut because of a number of factors, right? COVID, increased cost of litigation, especially in California. So our underwriters are really digging into the financials of companies, right? As a startup, things that could affect your costs would be, your net loss, right? How much money are you losing? When do you have to get that next new institutional round of funding? Are you going to have to take out debt to survive, right? These are all the kind of things that underwriters are looking at. And, Bryan was talking about how you want to present yourself to the insurance community, right? When you're looking for coverage. I'll just give you the advice that insurance underwriters look at you the same way an investor will look at you. The only difference is instead of investing, $20 million and getting equity out of it, they're investing limits of liability, right? They're saying, we will give you $4 million in coverage for $20,000. And that's their investment in you, in the hopes that you're not going to get sued, right? But they underwrite and look at you the same way an investor would. What's their growth potential? What kind of net loss are they having right now? What's their burn rate? How much cash are they going to need? Have they had any litigation before? Are there any regulatory concerns in their industry, right? So these are just kind of the factors that each underwriter is going to be looking at when pricing out a director's and officer's insurance policy.
And Brendan, to chime in here to help everyone in their future endeavors as they explore D&O, one of the biggest focus points that we try to direct clients to provide narrative or highlight financial standing on is the ability to sustain operations for 12 to 18 months. Bankruptcy is one of, if not the biggest concern from a D&O underwriting perspective, and being able to sustain operations and provide that your balance sheet can support operations at the burn rate that Brendan mentioned for that time period takes them beyond the traditional 12-month insurance policy. So it's providing the underwriter a little cushion, a little breathing room that the overall company organization will be sustained and flourishing within the timeline that the actual insurance policy could trigger and pay out on the loss and respond to.
Yeah, I guess I forgot to kind of highlight one thing in regards to the D&O policy, which is really the benefit of a D&O policy. You say like, oh, this will never happen to me. Why do we need D&O? If I don't get institutional funding, do I really need to have it? The biggest benefit of a D&O policy is the fact that it's called a duty to defend policy. Well, most cases for startups, there's a couple different types, but for you guys, you're going to be seeking a duty to defend policy right when you start your insurance purchasing path or whatever you want to call it. And that benefit is that, number one, it covers all of the legal fees associated with a covered claim against you. So essentially, you can just take your check that a law firm was going to hand you a check saying you owe us this much of hours for working on your behalf. You just get to take that check and hand it straight to the insurance company. They're paying for it. They pay for all defense costs if there's a covered claim, right? They're not just going to pay for everything. It has to be covered by the insurance policy. But if it is covered by the insurance policy, then all those legal fees would be covered, minus your deductible that you'd have to pay. Second benefit is you guys are startups, you're entrepreneurs, you're founding companies. You don't want to be dealing with a lawsuit, right? Unfortunately, when they happen, you're going to have to deal with it, right? But with the insurance company's help, you'll have to deal with it way less. They'll be the ones that are selecting defense counsel for you. They have, relationships with tons of law firms and know which law firms to go to for which particular cases. So the burden on you is drastically reduced because you can outsource that directly to the insurance company. So everybody says it's never going to happen to me. It's never going to happen to me. I can assure you, if you start a company, chances are pretty high if you're operating for a while, you'll get sued at least once, and you'll be very thankful that you had your insurance policies to protect you. I think that's it for me, Brian.
Perfect. Thanks, Brendan. So another complementary coverage that falls into the management liability umbrella that I previously mentioned and coincides with D&O is employment practices. Oftentimes, D&O and EPL can be packaged together with individual carriers, and there's pros and cons when you do that. Sometimes you can get decreased rates. Other times you can scale limits. You have a carrier that's more vested because they're putting more chips in, so to speak, and they're willing to collect, or in doing so, collect more premium and willing to adhere to any special requests that you have from a coverage perspective. So what is EPL? Taking that kind of macro high-level view, its core coverage intent is to protect you against harassment, discrimination claims arising from the management of your workforce. Now, a contemporary EPLI policy for a private company like a startup casts a very wide net in what we call the wrongful act definition. It's not just limited to harassment, discrimination. And you'll see on this slide, there's a number of listings there. I was just reviewing a policy this morning and it had 20 different listings for covered wrongful acts that are associated to any kind of employee workforce engagement. So that's from the application phase through interviewing, through employment, and ultimately if there ever is a discharge, reduction of force, etc. Any kind of alleged misstep where there could be harassment, discrimination, defamation, etc. You have coverage via an EPL policy if it's in place. Similar to what Brendan said, they follow the same kind of structure as a D&O policy in providing a duty to defend. So there is defense to navigate those claims, whether they are allegations, whether they do have merit or are meritless. And ultimately, if you are found at fault, it'll actually extend to the damages and indemnification side of it as well. I would note that you'll see one listing in there noted as wage and hour. Wage and hour is not a guaranteed coverage on EPLI. That's for oftentimes misclassification of employees, commonly in California between a W-2 and an independent contractor, failure to actually document or pay appropriately for meal breaks, etc. That is a very unique coverage that can be attached to EPLI. It's difficult to do for the most part, especially in California, just because of the high litigiousness nature behind that. But there are some carriers that are still willing to offer it. Those that do offer the wage and hour coverage, they do so on defense-only basis, and it's usually at a sub-limit. So it's not this blanket coverage or broad sweeping coverage agreement that your traditional harassment discrimination coverage is in the EPLI. The other point to make is that EPLI is not just on that what we call the first party side. It's not just covering the company, its management team, and their interaction with the workforce, which are all deemed to be first party, a part of the company, and working on behalf of the company. It also extends into what we define as third party. So anyone that is engaged or interacts with your company or personnel through the course of operations. And we can dive deeper on that in a later slide, but the ultimate motivation in buying EPLI in the past, especially in California, it was a frequency driven motivation or factor. However, recent trends with the hard market that Brendan alluded to, COVID impacts on businesses, whether they be vaccination requirements, et cetera, are escalating EPLI losses to also be severity losses, where traditionally you could settle claims under a six-figure payout. They're now well beyond that. And the actual seven-figure payouts are increasing more and more as you look at EEOC statistics and other law firm statistics that are being published. So moving on to the next slide. We'll
hey, Ryan, there was a quick question from Laura. She asked, when's the right time for EPL coverage? You know, is there an employee threshold? People should start thinking about that.
Perfect segue to the next slide. So your timing is impeccable. So when should you actually consider purchasing EPLI? And this is the very generic response of obviously establishing the workforce. And that kind of gets into the question at hand. Someone from our position on the broker side, where we try to transfer your risk to the insurance carrier as much as possible and work in the company's best interest. The minute you're hiring folks is when you should be evaluating EPLI insurance, because any misstep, again, it just has to be alleged to actually incur defense costs to navigate or combat those allegations, are going to affect your balance sheet and the company pockets, and ultimately be naming an individual director and officer who's also running the management side for the workforce itself. So having said that, when do we commonly see EPLI being purchased? It is oftentimes packaged with D&O, because a lot of the same carriers writing D&O they specialize in EPLI as well. If you are in an industry that is very outward facing to client, customers, vendors, think hospitality or restaurants, hotels, etc., then the third party coverage is a huge selling point. And they want to actually secure coverage, not just for their own workforce, but for that third party exposure as well. I can say that from a startup standpoint, D&O is usually purchased first if there's budgetary concerns and EPLI has been priced out and couldn't have been purchased at that time, but it follows quickly thereafter. And it's really only the reason D&O goes first is kind of what Brendan alluded to, in that you're being forced to do so via some investor requirement that they're trying to protect themselves and provide D&O policy to be the kind of first step and layer for that protection. So it's not a black and white answer. I don't have one. If you're in this industry or this jurisdiction or domicile and you have an employee count reaching 5, you should buy at that stage. It's really when budgetary ability permits. So similar to what Bryan and Brendan outlined in the GL and the D&O, trying to understand how the underwriters approach EPLI and pricing that out for various companies is very similar. The focus point or primary rating basis for EPLI is going to be that second bullet point. It's going to be your workforce size, so your body count. And EPL underwriters can actually scrutinize to your benefit and delineate between full-time employees, part-time employees. If you're in an industry that regularly employs seasonal employees, say, for example, agriculture, what have you, and then all the way to independent contractors as well. Obviously, full-time employees will carry a higher rating because there's greater exposure if they're working more often, more frequently, and it trickles down to a slower rating scheme for part-time, seasonal, et cetera. Legal history is huge. Anytime there's a company or founders that have previous litigation tied to them as it relates to EPLI, that's going to come into scrutiny, even if it wasn't under the current company itself. Underwriters look into that because it could set precedents as to how the company is being run, who's in charge of it, what their individual past experience was from a management perspective. From there, they actually dissect a bit further. What industry are you operating in? There are higher hazard industries on the first party basis to the third party basis and jointed together as well, which conjure up higher rating from EPL underwriters. And then domicile, with California, unfortunately for this group, being the most scrutinized region in the United States. There are certain insurance carriers that write management liability, D&O, EPLI, fiduciary, and they just redline California outright. They don't see it as a area that they can write profitably for their overall portfolio, so they stay out. Others that do operate in that space do so with higher rating. They impose higher retentions to make sure the insured has more skin in the game, or they add restrictions to help manage their overall exposure through the actual insurance policy itself. And then one area I wanted to throw on here at the end is actual the financial position. In preceding soft markets where financials are scrutinized on the D&O side more so than any other insurance policy out there, it is actually leading into the employment side. And that's largely based on economic downturns and what COVID has done to various industries with shutdowns, et cetera. And the correlation there is from the underwriting perspective, if a company's balance sheet or ability to fund operations is not as sustainable to carry that 12, 18-month mark, it's not just a D&O exposure in their eyes. They actually see and forecast that there are going to be reduction of forces. And anytime you have reduction of force, people being laid off, they no longer have that salary coming in. They're going to look backwards to the previous employer to try to find some kind of payout and conjure up some allegation against them to secure such through litigation. So that is morphing back into the EPL underwriting scheme, that sometimes you may encounter an EPL underwriter scrutinizing your financials similar to the way that D&O underwriter does.
I think it's important to point out too, Ryan, that there doesn't actually have to be a wrongful act that was committed. Here in California, the law and the legal system is so in benefit of the employee versus the employer that an employee can practically allege anything against you, right? If you guys are not documenting like the reason why performance has been bad, and this is as you grow too, right? I don't think you have to think about this on day one, but if you're not, documenting why an employee's performance has been bad, giving them opportunities to do better and so on and so on, the employee can just allege a wrongful termination claim against you for pretty much anything. And California is so friendly to the employee, whether that is right or wrong, it is going to cost you legal fees after, tons and tons of legal fees. And so EPLI is probably the most common line of insurance that sees claims. So, chances are if you start a company, you will have an EPLI claim at some point, and you might not have done anything wrong, but they will allege it. And because California, the state legally is so friendly to the employee, it's going to cost you money just to defend yourself. And that's the biggest benefit to EPLI insurance there is.
Yeah, I see a couple questions coming in, and I want to make sure we address those while we're focusing on the EPLI slides. The risk with exempt employees versus non-exempt, that would tie back to the misclassification that I alluded to, and again, lead into wage and hour exposure. So wage and hour, as I mentioned, defense only, sublimited. It's not offered by every EPLI carrier out there. You have to find the handful that do offer it. But that again falls under the umbrella of misclassification. And then the PEO question is a phenomenal one. Yes, PEOs can provide some level of EPLI insurance as part of their overall offering. However, there are limitations attached to that. And we actually have a flyer that we could send out after this call just for quick reference. The crux of it is that PEOs create a singular EPLI policy in their name for their company. And they've negotiated with that given insurance carrier to extend to their portfolio clients themselves. So by definition, you're not a first named insured. You're kind of a secondary insured classification to garner coverage through this master policy, if you will. Because it's a master policy, that insurance carrier is rating for significantly higher employee counts than just your company. They're looking at it from the PEO themselves and all their own clients. And anytime you start seeing the employee counts increase, as I noted, it's the primary rating basis for EPLI, underwriters are going to start carrying more exposure. They're going to start requiring the insured to put more skin in the game in way of the self-insured retention. So a PEO EPLI insurance policy usually carries a six-figure retention of $100,000, sometimes upwards of $250,000. And you would be responsible to pay that first amount before the carrier ever pays $1 against any claim that comes in. Similarly, there's other coverage nuances that are inferior under a PEO employment practices policy versus getting your own dedicated policy. But again, that follow-up flyer that Bryan can circulate out speaks to all that in great detail. Now, I say all that, and it's obviously heavily slanted to a standalone EPL policy for your given organization or company. That being said, it goes back to Laura's original question is maybe that's a good stopgap initially to get some coverage rather than being entirely bare, entirely self-insured until budgets permit to buy your own standalone policy itself. So it's not something you're looking to rely on for the long haul, but in year one or the first 6 months, it's a avenue to do so at cost and provide some level of coverage.
Ryan, with how do I frame this? So I know there's some bills, state bills being fought about gig workers and making them full-time employees. How does EPLI coverage fit in with gig workers and just that ecosystem, those type of companies that would employ them?
Yeah, it's all based on the type of allegations behind the complaints, the suits, class action movements, what have you. If it's purely misrepresent or misclassification, then unfortunately you're falling back to that wage and hour clause, and wage and hour is again a limited coverage attachment. If there's broader allegations of wrongdoing, again tied to or discrimination, most notably, or others as we listed in the previous slide, then you can actually open up the policy limit a bit more and work to your favor. But unfortunately it's driven by the plaintiff attorneys and how creative they are in structuring the actual complaints or suits themselves and navigating their ways to trigger the policies or not.
Perfect.
And I should note in a standalone EPL policy, because we're getting kind of technical here, and it ties back to the duty to defend provision of these private company policies, is what usually coincides with the duty to defend provision in DNO and EPLI on management liability side is a huge enhancement of allocation. And what you tend to see more often than not is 100% defense cost allocation, which means if you get a single covered wrongful act as defined in the policy listed in that complaint or suit against you, the carrier will provide defense against all allegations that are tied into that same complaint. So just having one trigger point trigger the policy in the grand scheme of a slew of different allegations can significantly benefit you having your own standalone policy, where going back to a PEO policy, they often don't include 100% defense cost allocation. So what the carrier does in those situations is they slice and dice what they're actually going to pay for, and you're going to be responsible for anything that they're not agreeing to.
Awesome. Thanks, Ryan. We'll move on to the next milestone here. And this is a pretty straightforward one. Here's a picture of the Airbnb offices in San Francisco. So this milestone, it's going to depend on the type of business you have, of course. So like a lot of these, I'm sure some of you may be planning on having a 100% remote workforce for the foreseeable future. But if you lease any type of space, I just wanted to go over a couple of things to consider with the commercial property coverage. So there's actually three types of coverage. It's the building itself, it's business personal property, which is anything 100 feet, within 100 feet of the location that's not bolted down, like office equipment, and then business income, which applies if there's a suspension of operations due to the location having to be restored or replaced from damage, if it's lost or damaged. And then this is actually different though than business interruption, which I think we talked about a little bit with the BOP. And it's also part of a lot of cyber coverages, which we might get into a little bit later. This is if a system is down, either yours or a third party's. But for commercial property coverage, underwriters are going to look at the age and location of the building. They're going to look at who's in a building, how it's used, and then the type of security or protection you have in place to reduce risk. Things like sprinklers, super important in California, alarms, security guards, etc. Workers' compensation, again, varies greatly more than a lot of other things in the type of business, but you're probably gonna get some coverage when you actually form your business. We just put in here for the flow's sake, but it's vastly more expensive for a roofing company versus a tech company. But you're gonna have some coverage no matter what. And it's actually required in every single state except Texas. Calculating your premiums though for workers' comp, really straightforward. Underwriters are going to look at the type of company you have, any history of workers' comp claims, and your payroll, of course. So again, you're going to get some workers' comp coverage earlier in this milestone, but I think it's just a really good time to revisit, look at your workers' comp if you do sign any kind of lease or you're renting any type of commercial property for your business, any office space at all. All right, I want to do a quick poll since it's been a little while here. I was just kind of curious how everybody's risk tolerance levels are feeling in this group. If you're fairly conservative, feel like your risk tolerance is super high and you are extremely risky, just curious. You have some really risky entrepreneurs. So I guess a little more conservative than I expected here. So this next, stop sharing that one. The next milestone is really our last one, but it's super important and it's going to cover signing a large client contract, signing a large partner contract, and in addition, just any rapid growth that your company is going to go through, and you all will. So obviously your sales team's pumped, going to hit the gong, spend that commission check, but before you sign that contract, there's probably going to be some added insurance requirements in there. And we see this all the time. So potential customer tries to, in that contract, put all the exposure on you, really high limits. So it's really important to know what to look for. You work with your attorney, you work with your insurance broker, and you have to know what to push back on as well. This is really important and very common.
All right, thanks, Bryan. So dovetailing off that, what usually follows in the succession of these milestones as you're evaluating other lines that fall within that executive lines coverages, professional liability and cyber. And as Bryan noted, these are largely tied to events like bringing on more clients, large client contracts, primarily based on the structure and nuance and intent behind these types of policies, that they are providing more broadened definitions and insuring agreements to contractual commitments that the company may be making. So the obvious one is you bring on a client, there's obviously a client contract in place. Certain E&O policies will provide coverage tied to just flat out breach of contract allegations, but then also negligence, errors and omissions, and failure to render commitments within that contract as well. So looking at the E&O side of this, not every company out there provides a service and warrants professional liability, errors and omissions. There are certain segments of professional liability that are different than others, whether you're a traditional company, professional service firm like a law firm. Excuse me, getting a call in here. Sorry about that, guys. A law firm, accounting firm, doctor, what have you. But then there's other miscellaneous professionals. If you're a bookkeeper, or what have you. And then the obvious tech side or new age kind of endeavors and industries. And each one of those carries its own segment within the broader professional liability marketplace. And they all have their own different forms dedicated to the exposure base for those industry segments themselves. Cyber is unique in that it carries a very broad sweeping intent and coverage extent to it. And it actually carries multitude of different insuring agreements itself, which we'll dive into on a later slide. And it also further picks up on regulatory coverage arising from privacy, security, et cetera, all of which can be tied back to claims from clients, claims from vendors, those parties, third parties, which you are engaging in contracts with. What do errors and omissions and cyber underwriters actually look at? They're similar to the D&O and the EPLI, and even GL for that matter. They're looking at the size of the company. More often than not, they're utilizing revenue to generate that as a primary rating basis. They're looking at the industry that you're actually falling into, as I mentioned, those different segments. And then from a cyber component, looking at the data itself, what type of data do you have? How much data of that are you housing responsible for? Or are you deemed the data owner per regulatory standards? And then ultimately, which Bryan will touch on a later slide, is really where the rubber meets the road with underwriters is security controls in place that you have. So diving a bit deeper into those, we'll go to the next slide here.
Yeah, I think, Ryan, did you want to mention that the basic premise of professional liability is to protect you from third-party lawsuits, such as those clients, and in a broad stroke, it's to protect your firm, your company from financial loss, right? You harmed them financially, right, by performing the contract negligently, or by they call it errors and omissions, by making an ignorant error or omission or not performing your service, right, up to snuff, and you essentially get sued for that, and it's to indemnify or make whole that that party that you negligently harmed in the performance of your service, right? So it's a true third-party coverage, and it's meant to protect you from financial loss associated to those services.
Yeah, thank you, Brandon. And to really paint as clear a picture as possible, professional liability errors and omissions, if you really break it down, it's three components. It's service provider rendering defined service as outlined in the contract to recipient, customer, client. And as Brendan noted, it's that third party reversing it, alleging that there was wrongdoing, error, negligence in the actual services or obligations there too from the provider themselves. So as we talked about, there are different types of errors and omissions policies out there. Technology E&O are dedicated forms, very nuanced. As you'll see, the common theme from all of them is that the intent and basis is negligence or wrongdoing in rendering said service. But Tech E&O has a huge benefit to it, just given the nature and scope of that landscape and how dependent upon they are in client contracts, is that they actually offer some broader breach of contract wording, where other E&O policies, non-tech related, some of the ones I talked about, from traditional firms to architects and engineers to miscellaneous professionals, their policy forms don't provide blanket affirmative breach of contract wording in the same fashion that a tech E&O policy does. That being said, there are carve backs that you can negotiate into those forms to help trigger some coverage in the event you have breach of contract allegations. So I think the high level takeaway from an E&O perspective is that there's various industry segments and therefore different forms tied to those, and they all are different from one or the other, and that's why it's important to have a specialty broker looking at that and structuring that for you. But the underlying basis of any E&O policy is that they're derived from negligence and allegations from third parties that are alleging financial loss. Some, as you go at this last bullet point, E&O forms are very nuanced to extend to bodily injury property damage claims that are arising from failure to render said service. But again, those are going to be industry segment specific, like construction, healthcare, et cetera.
Yeah, the easy, example is a structural engineer designs a building falls down, someone dies. That could be the bodily injury lawsuit, right? It's not necessarily going to be the client suing you, although he very well might. it's going to be, the estates of the injured party or deceased party that's going to bring the lawsuit against that engineer for, a wrongful death claim.
Yeah, and I would say, kind of dovetailing to the previous question before about timing for EPLI and timing for E&O. I mean, arguably, anytime you're actually engaging in client contracts, you should be looking at errors and omissions coverage at some level. Trying to get ahead of that as much as possible is beneficial. And part of the reason behind that is you get really granular on the topic is the errors and omissions marketplace. They actually establish a retroactive date on these policies, which will only cover going forward acts from that date forward. So if you have taken on 5 clients and you are rendering said service to them for a year and you buy E&O a year in, all actions and all services rendered prior to that date are not going to be covered. So if a claim comes in a month later after buying that policy and it ties back to wrongful allegations of wrongful acts preceding the retro date that the carrier established, they'll probably deny coverage more often than not. Sometimes you can negotiate that retro date being backdated, but if you're trying to be forward thinking and trying to stay ahead of that exposure, getting E&O in place when a client contract, your first client contract is coming on board is wise. And again, those early stages, your revenues aren't going to be as significant as they are 5 years, 10 years down the line. So revenue being the primary rating basis for E&O, the premiums aren't going to be as big either. So it's not as much of a cost burden on you as well.
There's also a couple of questions in the poll, I think. What type of insurance should starting out bookkeepers obtain as an independent contractor? That would be professional liability, the non-technology portion, right? Ryan and I have worked on numerous of those. It's just a standard professional liability policy that protects you for your services performed to your client, right? So in this case, you're probably going to get a better premium because you're not a true accountant, you're not a CPA, right? You're just providing what the underwriting community would deem a slightly lower hazard service than being a CPA and performing an audit, right? So that would be a very, not to call it basic, but in the insurance carrier world, that would be a very kind of basic professional liability policy. And it's actually one of the most liked industries from an insurance carrier just because there usually are such few claims. So in that case, you probably see a very competitive premium number, especially as a startup, because your revenues aren't that high. And then Ryan, I don't know if you've seen the chat, there's another one that you might want to handle, but essentially has to do with business interruption due to the pandemic and employee issues. I know that there was a lot of publicity in the news about BOP policies not picking up business interruption related to COVID because of X, Y, and Z reason. Is that kind of what you're getting at? Or are you talking about business interruptions because employees cannot return to work? I don't know if whoever had the question wants to double down on that, or if you got some commentary, Ryan.
Both.
Both.
Oh. So this is tough because a lot, at least from our perspective, where Brendan and I operate and our specialties, the executive line, management liability, professional cyber, unless you're in a very segmented niche, like we're talking about with errors and omissions, where there is an extension for bodily injury, property damage claims, and other broadened enhancements to just financial loss. There are bodily injury exclusions throughout the vast majority of these forms. And with that, there's similar exclusions where these professional lines carriers are trying to specify intent to other products. So business interruption in its true sense, and Brian, I think this is where you probably have more experience than Brendan and I, is going to be more on the casualty side and more tied back to the first insurance products that you were looking at of general liability, BOPs. And Brian, correct me if I'm wrong, this is outside my specialty as it relates to business interruption on casualty.
Yeah, no, I think you got it, Ryan. I mean, I think it's a little bit more on that side. So, yeah, I don't really have too much to add. I mean, I think it's, as you said, now there's, I think what Brendan was saying, there's a lot of news about it. I think there were some headlines that made it seem a little scarier than it was, but it's just a good idea to always look at your policies with your broker really closely due to some things like that. I don't think there was too many cases, Ryan and Brendan, if you guys back me up on that, of insurance companies trying to basically screw companies out of coverage because it's a once in a lifetime pandemic.
Yeah,
so I don't think that was as prevalent, right?
There was a little bit of it, and most of it was overseas, actually, in Europe. But the premise was that oftentimes there wasn't an exclusion for pandemic, right, in the forms that they would cover it, but it usually had to be a pandemic or injury suffered on the business owner's property. That was the insurance carrier's cause of declining claims. It was like no one had COVID at your place of business, so you were not shut down. You didn't suffer business interruption because of a spread, disease, whatever, at your place of business. You were forced to shut down by the government. So there was all of this litigation involved, mainly in Europe. They were trying to distinguish between the points of, should the insurance company pay for this? Should they not pay? There wasn't an explicit exclusion, but there wasn't quite an explicit coverage trigger. Ultimately, I think what happened was some of the insurance carriers settled, for an amount lower than the true coverage, just because it wasn't quite exactly clear who was going to pick it up. So I know that was in Europe, but just kind of gives you an example of the way that these things are thought about and how they're affected. So in the US, right, for these policies, it'd be important for your broker now to look out and see if there is some type of explicit exclusion for pandemics in your BOP policy, or the language that needs to be in there to trigger, right, that it, or shut down by the US, right, that you can't operate your business and you suffered business interruption because the government forced you to close. The gentleman in the chat brought up a very interesting point in my mind of what happens if you're not allowed to come back to work because you don't have the vaccine, and if the vaccine's mandated, then you're suffering business interruption because your employees can't physically do the work. I just don't think that that's been addressed yet, because it's happening now, right? So another thing to look out for when you're purchasing insurance policies would be these exact questions. And, Brian, Ryan, and myself as your brokers, this is what we're fighting for you guys, like on the ground floor, right? Right when the pandemic hit, it was very common that insurance carriers overreacted and we're putting an exclusion for COVID, anything related to COVID on a policy. And Ryan and I spent months and months and months just fighting to get that exclusion removed whenever possible. It was a lot harder in segments such as medical, right? If we were doing an inpatient operating or a nursing home or anything like that, it was really hard to get insurance policies without a COVID exclusion, just because the carriers thought that the risk was too great to take on, as it could obviously spread like wildfire through a nursing home. So these are just things that you have to think about when purchasing coverage.
Yeah, just to button up that thought and kind of a takeaway as you digest that going forward, because to the question at hand, there's no blanket or dedicated affirmative pandemic insurance coverage that I know of out there to cover that. And if it is, it's going to be extremely expensive, just given the uncertainty tied to this. What we're talking about, and underwriters thrive or don't thrive under uncertain situations and dynamics. That's like the worst case scenario to work with an underwriter when they're uncertain about something. The current snapshot of the marketplace is that previously, as Brendan noted, some policies, especially on the casualty side, showed some ambiguity, and it worked in the favor of clients in some insureds in some areas, and some carriers took hardened approaches and just knew they were going to fight a legal battle later on. So you've seen it kind of go both ways. Others, now that it's progressed, as Brendan just alluded to, have tried to draw a line in the sand and say, this is not our intent, it never was. Here's new exclusions, here's broader exclusionary wording to distance ourselves from it. The brokers are constantly battling that, trying to keep coverage as open as possible. but it really depends on what the true exposure is to that company that you're looking at, and what information you can provide to the underwriter to help build their comfort in offering some coverage for it. And I say that we worked on a very large group of healthcare facilities in California earlier this year, and literally all 50 professional liability carriers that we were working with had COVID exclusions. They didn't want to touch it. It was something that they felt no insured could actually transfer risk or manage risk from, so they didn't want to cover that risk. We were able to gather a ton of information. It was extremely labor intensive in working with the client, and got affirmative COVID coverage for all these facilities. Granted, it was sublimited. It wasn't as full-blown limits and had its restrictions. It was better than an outright exclusion. So in that scenario, there was a lot of premium to it. We're talking about a very large organization, but there was an avenue to negotiate with the underwriter, and its information is key. You've got to bring something to the table to the underwriter. If you're just asking for a coverage without any supporting detail or information, you're probably going to get an underwriter that digs in the sand and just excludes if the policy already includes it. So that, I'd say the big takeaway is, if you have a big concern with it, work with your broker, see what's out there. Fingers crossed there is an avenue to pursue to get some level of coverage, but don't hold me to that. Some scenarios you just won't be able to. So then I know we're butting up on the end here. I'll run through the cyber side. I mean, we could spend a whole day talking about cyber, given the array of coverages found in the contemporary policy that I mentioned before, but also just the trends that we're seeing. This is cyber in the past 5 years was in one of the softest markets we've ever seen. You had carriers quoting off 3 to 5 pieces of information, offering millions of dollars in coverage for policies that were $750 to $2,500. It was just cheap, inexpensive, very streamlined underwriting cycles and processes. And now the whole thing's been flipped on its head, with claims coming in, especially from ransomware, and ransomware bleeding into other coverages of the cyber policy. These claims payouts, even for small companies, can be in the 7 figures. So the cyber underwriters are scrambling. They're trying to figure out how they can manage their overall risk as it relates to the exposure that they're covering. And it's kind of a free-for-all, and who's asking what. I know Bryan can touch on some of the areas of focus for you guys as the business owners and running the companies and approaching these insurance carriers. But from a high-level standpoint, cyber risk pertains to privacy, which is relating to sensitive information and data, and then network security. So the IT infrastructure that the business is operating in or utilizing to run operations. Any type of cyber event that is impacting those, that isn't specifically excluded, is going to trigger and be directed towards a cyber policy. And you want to have a dedicated cyber policy for that, because other insurance policies don't adequately cover it to the same extent that a cyber policy does. So really granular coverage components of such, running through this very quickly, just for the sake of time. First party coverage is really the bulk of the coverage itself, and why most people buy the coverage. Some carriers actually show statistics that 85% of the claims they pay are tied to first party coverages. So there's no third party alleging financial loss at this time. It's just you triaging and mitigating a cyber event in real time at incurring costs, accessing vendors, trying to minimize the scope of the damage itself, and just get back on your feet, so to speak. Ransomware, again, number one, hands down. The vast majority of underwriting questions is going to be tied to risk mitigation to prevent ransomware. Cybercrime bleeds into funds transfer fraud, someone breaching your network or credentials and transferring money off of your own bank accounts. Social engineering, transferring money off, but not through a breach, just duping you, purporting to be a vendor, purporting to be someone within the organization, and directing money off. And then there's the business interruption following cyber event, data restoration costs following cyber event, and the ultimate reputational harm following a cyber event itself. There's a whole myriad of other coverages that we can get into, but that's the crux of the first party. Third party is, once the dust is settled from that cyber event, and you do have these third parties that are now coming after you because they've suffered financial loss, they can trigger the privacy liability if it was tied back to data or information being compromised, or the network itself, any of the IT infrastructure, and then ultimately the regulators at state and federal level, or even international level for that matter, if you have that reach.
Awesome. Thanks, Ryan. So yeah, good segue into some controls. And so this all is going to be what, underwriters are looking for, but also, these are just simple things that you can implement right away for low or no cost. If you have clients as well, let them know about the stuff. It's really easy. Again, going to make you more attractive to underwriters. Sometimes they're going to be requiring some of this, but also just as attractive to those investors you're looking for. So if you look at the bottom of the slide, just a good attitude towards cyber risk, that's really the most important thing, having that mentality. So that's what they're going to be looking for. All of these other things are just tools, easy to implement tools. Multi-factor authentication, I get it. It's a little inconvenient, but it's easy. Some tools there I like: LastPass, OneLogin, Duo. Having multi-factor authentication or two-factor authentication is potentially can block 99% of all cyber attacks. It's just the easiest, it's the cheapest, and the most practical control that you could put in place. I recommend everybody just does it, today, as soon as we're done. The second one, business continuity plan, important part, similar to your risk management program or risk management plan. It's just to put it down on paper, type it down, revisit it, go over with key personnel. And a good plan is going to recognize potential threats to your organization, and then look at what impact that they might have on day-to-day operations. What happens if you're hit by a ransomware attack? It's simple things like that. I mean, who do you call? What do you do? What do you do first? What happens if your payroll vendor goes down at the end of the month? This happens a lot. Can you cut a paper check? Look at kind of some alternatives for your plan just to keep your business up and running. And remember, you have to rely on a ton of vendors, a ton of partners. What happens if a ransomware attack happens to them? Training your employees, really, really important. Once you have them, it's something underwriters are looking at more and more. And again, there's a ton of free training online that you can find, but there's some good services out there. KnowBe4, it's what we use here at Bender. Definitely recommend them. InfoSec is another one. They do a really good job, and they're going to help you not only train your employees, but they're also going to test it. So like us here, we went through the training, and then they send out occasional phishing tests, and if anybody clicks on them, they get sent into some more training. So it's just really cool and worthwhile things to do. And then I recommend password managers for everyone, but especially for businesses. MyKey, PassHub are good tools that I like. And then a lot of these services manage your passwords and also do authentication, so you can double up. And then backing up your systems, backing up your data, really important. Do it regularly, segregate those backups, and have offline backups as well. And then just have the basics. If you just have someone helping you out with IT, if you use a managed service provider, make sure you have your antivirus up to date. Your employees should be trained to always update those types of softwares, encryption. Make sure you have all the basics in place, and then again, just update them. This is gonna all be linked. And lastly, I'll just leave you here. So the NIST cybersecurity framework, it's really important. There's the link there. You can just Google NIST cyber framework. So this was done by the U.S. Department of Commerce. They designed the framework to help businesses of all sizes really understand and reduce their cybersecurity risk, and then protect your network, protect your data. So we talked to a lot of people. I think Ryan mentioned it, Brendan mentioned it. They think they're just too small to be a target, too small to be a cyber target, and they're okay maybe with a bit of risk, but that's just not okay, not the case anymore. It really doesn't matter what size of company you are. It's just how vulnerable you are. It's just so cheap and easy to be a ransomware threat actor now that anyone really is a target. And then I'll just leave you with some fun and scary stats to hammer that home. 60% of all cyber attacks are now against small, mid-sized businesses. Business email compromise incidents went up 51% in the last year. Work from home has a lot to do with that. And then the average ransomware demand has gone up just a ridiculous 170% in the past year. And then if you saw another TV show recommendation, because I guess that's what I'm doing, John Oliver just did his most recent show about ransomware. So highly recommend check that out. I think we're going to just skip that poll. Not a ton of value there, but I wasn't sure if there was any further questions that we can answer when we have everybody here, let me know. I had one question sent to me though. If there are any, throw them in the chat, or you can always unmute yourself and ask. But someone sent me a direct question about carrier tools. So is there any, Ryan and Brandon, if you guys wouldn't mind covering this, I guess it was more about the type of tools that carriers can offer you. So not just the insurance piece, but can they help at all with your cyber? What do the carriers offer that's worth knowing about?
Yeah, it's a phenomenal question, and it's a great selling point and benefit to insureds that we always try to highlight. It varies by the carrier, so it's something to definitely vet out if you're exploring different options from a cyber perspective. But the cyber carriers, given the onslaught and negative trends that they're seeing and losses over the past couple of years, they're committed to not just being reactive. A lot of the insurtech cyber carriers are leading the charge in this regard, and they're actually providing external monitoring of your overall network and IT footprint. They're actually providing the employee training that Bryan was alluding to and recommending. The carrier will provide that free of charge because they want to be as proactive to mitigate the overall risk that they would have to end up paying in advance. So the short answer is yes. Some of the carriers out there are offering a whole slew of services. They almost all offer an online portal where it's kind of a la carte clicking, gather whatever resources, if it's, policy templates for IT security, et cetera. And some go above and beyond for the scan. Some actually can get you in contact with privacy professionals to vet out individual questions that you may have specific to your organization, et cetera. I will say that it's not just this open-ended IT offering with a blank check behind it. There are, fine periods at some of these offerings that they can ultimately connect you with an IT professional or vendor that they're contracted with that you would have to pay, but that's for more in-depth servicing, whether you're looking for, full-blown pen testing or what have you. They have resources to connect you with, but their resources that are free of charge can at least get the ball rolling on some of the initial endeavors you're looking for.
Yeah, I would just highlight too that, Ryan was kind of touching on it, but they have partnerships with all the best firms like CrowdStrike, Palo Alto Networks, all these firms. You oftentimes can get reduced rates just through them, through their marketing materials, right? So they'll send us a bunch of flyers if you bind coverage with them, and we pass that on to people like Bryan and pass it on to you, and you can get deals for some high quality service providers at a little bit of a better price. And then also, the kind of going back to the scanning that Ryan was talking about, a couple of the new insurtechs that he spoke about are actually providing you with security recommendations now. This is how you can go ahead and shut down that open port, or you should implement this to improve your security. So it's kind of exciting times in the midst of a big increase in ransomware, but the insurance companies are definitely getting more technological and data focused, and it's shown in their offerings over the last year or two. So I'd expect that to increase as just the sophistication of these cyber criminals continues to rise.
Yeah, and just to throw one last point in there is that isn't limited to cyber either. Depending on the carrier you're working with on the D&O and EPLI, they have risk management offerings as well. Obviously, those are more liability-focused coverages, so it's kind of different cadence to it. But they can get you in contact with HR professionals, labor attorneys, and then other types of corporate attorneys on the D&O side. But just vet that out with your carrier, because a lot of these executive lines, insurance carriers are trying to be very forward-thinking on the risk management side.
Cool. So I would say there's no other questions. I think we could probably wrap up early, Laura and Jeff. Not too early, but it's. I think we've probably talked enough.